Welcome to The Explainer. Today, we are investigating a truly massive transformation in the financial world. You probably remember Robinhood's chaotic early days, right? You'd open the app, buy a meme stock, trade some crypto, pay zero commissions, and call it a day. Well, that simplistic version of the company, it barely exists anymore. Behind the scenes, they have quietly and aggressively built a sprawling financial empire. And today, we're unpacking the central mystery of how they actually pulled it off. So that brings us to the core investigation today, and the stakes here are incredibly high. Is Robinhood truly cementing itself as the next great financial operating system for a whole new generation of investors? Or, underneath all this explosive growth we're seeing, is their success still dangerously dependent on active day traders? I mean, if the market gets boring, does the empire crumble? To answer this, we've got to look at the numbers, because the old narrative just doesn't fit reality anymore. Okay, let's dive into this. $1.31 billion. That is Robinhood's record-breaking revenue for Q2 of 2026. This isn't just a slight bump, it's a massive 32% year-over-year increase. And it gets even better for them. Their net income jumped by an astonishing 48%. For a company that Wall Street once completely dismissed as a speculative flash-in-the-pan fintech, these are serious, undeniable numbers. But we do have to ask, is the business fundamentally better, or is trading activity just unusually high right now? To figure that out, we have to follow the money. Look at this breakdown. It reveals Robinhood is absolutely no longer a single-engine vehicle. They've got multiple massive revenue streams now. Net interest alone brought in $389 million, and their other revenue hit $143 million. However, the largest slice of the pie is still transactions at $776 million. This is huge. It shows that while they are successfully diversifying, a massive chunk of their economics still relies on people actively hitting those buy and sell buttons. If you want to fully bust the myth of the one-trick pony, the contrast here is just stark. The old Robinhood was essentially just commission-free stock trading. The new Robinhood? They now have 13 distinct business lines that have each reached at least $100 million in annualized revenue. Just think about that scale for a second. We are talking about equities, options, retirement, credit cards, margin, cash, and even AI trading. They are systematically moving away from just monetizing a single trade to monetizing an investor's entire financial life. Now, what's really interesting about this slide is how it completely destroys the crypto trap narrative. Critics have long said Robinhood would live or die by cryptocurrency volumes. And yet, despite crypto revenue dropping 38% in Q2, their overall revenue massively accelerated. Why? Because equities surged 95%, options grew 29%, and event contracts grew by literally more than 10 times. They have finally proven that they can grow even when crypto weakens. We absolutely have to talk about that explosive 10x growth because it is fascinating. This is the prediction market boom. In Q2 alone, Robinhood users traded 13.6 billion event contracts. That generated $156 million in revenue. Instead of buying a company's stock, users are trading contracts tied to real-world events, things like politics, sports, or economic outcomes. It's incredibly lucrative right now. But you have to ask yourself, is this a durable new foundational revenue source, or is it simply just the newest flavor of high-risk speculation? But honestly, regardless of what users are trading, the wealth accumulating on the platform is staggering. Funded customers only grew by 7%, reaching 28.4 million. But total platform assets, those surged by 32% to a massive $369 billion. This is an absolutely crucial metric to grasp. Robinhood doesn't necessarily need to add millions of new users to grow anymore. Their existing users are becoming dramatically wealthier and infinitely more valuable to the platform. Which brings us to another foundational pillar of their new empire, 4.8 million. That is the number of Robinhood Gold subscribers, and it is up 39% year over year. So why does this matter? Because it represents a critical psychological shift. Think about it. A free user generates unpredictable, occasional transaction fees. But a Gold subscriber, they generate predictable, recurring subscription revenue every single month. They are literally transforming their user base from transient day traders into locked-in subscribers. And this brilliantly illustrates their ultimate master plan, the ecosystem moat. It's like a giant puzzle. You start by opening a simple investing account. Then they offer you high-yield cash management. Next, you get their Gold credit card, which, by the way, has already crossed 1 million customers and $17 billion in purchase volume. Finally, you move your retirement accounts over. They are systematically capturing your entire financial life cycle. The more products a customer uses across these steps, the harder it becomes for them to ever leave the platform. And the absolute proof that this ecosystem strategy is working is a staggering $21.7 billion in net deposits for just one quarter. That translates to an annualized growth rate of 28%. This is arguably the strongest clue in their entire earnings report. It proves Robinhood is no longer just a chaotic casino for quick trades. It's becoming a boring, reliable vault, a place where serious money is deposited, stays, and compounds over time. So, they're building a super app, the deposits are flowing in, and revenues are at record highs. Sounds like a flawless victory, right? Well, as anyone who studies markets knows, a seemingly perfect narrative usually hides structural risks. We need to systematically peel back the onion on the underlying economics of this massive platform to see what actually happens when market volatility dies down and customers inevitably trade less. Let's investigate the hidden risks. The first major risk hides right in their lending practices. Robinhood's margin book reached $21.6 billion, a massive 127% increase year over year. Now, on paper, this is fantastic because lending generates very strong recurring interest revenue, but it's a double-edged sword. When customers borrow heavily against their securities, it introduces the severe risk of forced selling during extreme market crashes. We really have to ask if Robinhood is monetizing customer confidence or if they are dangerously monetizing customer leverage. Then there is the interest rate problem. As we discussed earlier, net interest revenue hit $389 million, but the growth rate here is concerning. It's up only 9%, despite that massive 32% surge in total assets. This highlights a real structural vulnerability. If the Federal Reserve continues to lower short-term interest rates, Robinhood's interest income per dollar declines. So even if their users deposit billions more, falling Fed rates can silently erode one of their most profitable, reliable revenue engines. Next, we need to rigorously scrutinize their capital allocation. Robinhood has an active stock buyback program. Cumulatively, they've bought back shares at an average of $47 a share. But in Q2 alone, they repurchased $414 million of stock at an average of $94 a share. Are they still buying their own stock at a discount because they believe in the long-term value, or is management simply throwing cash at the stock at the absolute top of an enormous rally? It's a vital question for any potential investor. And of course, there is the regulatory shadow. Robinhood's aggressive expansion into alternative products like crypto and event-based prediction markets inherently increases their regulatory exposure. It's an undeniable paradox. Their most lucrative, fastest-growing new revenue opportunities are simultaneously their biggest regulatory headaches. Their transaction revenues depend heavily on the rules governing how these alternative markets operate, meaning a single policy change could severely restrict a massive growth engine. When you stack all these risks together, the bear case comes into really sharp focus. Imagine this scenario hitting all at once. Overall market activity collapses, so trading revenue plummets. Simultaneously, crypto crashes again. The Fed slashes interest rates, eating into net interest income. Regulators tighten the screws on prediction markets, and heavyweights like Charles Schwab or Coinbase intensify competition. The ultimate question for the skeptics is this: is Robinhood's newly diversified business model truly resilient enough to survive all these shocks simultaneously? But to be completely fair, the bull case is equally compelling, and it builds like a beautiful chain reaction. It looks like this. Net deposits keep rising, meaning platform assets continuously compound. This attracts more Gold subscribers, which fuels massive credit card and margin expansion. They scale their new AI agentic trading tools, keeping engagement incredibly high. If this cascade executes perfectly, Robinhood transcends being just a broker. They achieve undisputed super app status, becoming the primary all-in-one financial platform for an entire generation of younger investors. Let's move to the market reaction and see how this builds into what professionals call a psychological trap. After these earnings, Robinhood shares surged 13.7% in a single session, closing around $108. When retail investors see a jump like that, the instinct is to think, wow, something huge is happening, I need to get in. But a professional investor asks a totally different question. What actually changed in the intrinsic value of the company today? Because an improving business might already be priced as a dangerously expensive stock. And this brings us to a critical investing concept you need to know for high flyers: multiple compression. If a company is growing at 30%, it commands a premium valuation. But if that growth naturally slows down while the stock remains priced for perfection, the multiple collapses. This perfectly illustrates exactly how you can lose money buying into a fundamentally great, highly profitable business. Which leaves us with our final verdict. Robinhood is undeniably a burgeoning financial empire. The days of it just being a meme stock app are over.
But the ultimate question you have to ask yourself before making a move is this: is Robinhood actually growing faster than the steep price investors are currently paying for that growth? Food for thought.